All right, today we're going to skip all the usual investment advice you hear everywhere. We're diving into something that the pros obsess over: how to actively control the risk in your portfolio instead of just crossing your fingers and hoping for the best. This quote from our sources, it just nails the whole point of what we're talking about today. It perfectly sets up the main battle every single investor faces. Are you operating based on hope, or are you operating with control? Because let me tell you, in the world of finance, those two things are on completely different planets. I mean, really think about it. When you're just hoping for something, hoping a stock will bounce back, hoping the market turns around, you're being totally passive. Hope isn't a strategy. It's basically you handing over the keys and saying, I guess we'll see what happens. Professionals don't do that. They don't hope, they build a plan. So, the big question is, how do you actually do that? How do you make that trade from hope to control? Well, that's exactly what we're here to unpack. We're going to look at the tools and the mindset that the pros use to protect themselves from whatever the market decides to throw at them. Okay, let's dive in. Okay, so before we can even think about controlling risk, we've got to understand what we're really up against. See, most people think risk just means my favorite stock went down. But the reality is so much bigger, so much more complex than that. There are actually three hidden risks you absolutely need to know about. So let's break down the two big types of market risk. On one hand, you've got what's called non-systemic risk. This is a problem that's contained to just one company or maybe one industry. The BP oil spill is a perfect example. Our sources call it the broken pipe incident. I mean, the company's stock got totally hammered, right? Cut in math. But if you own shares in other unrelated companies, you were pretty much fine. But then you have the really scary one, systemic risk. This is when the entire system catches a cold. Think 2008. When that happens, it doesn't matter how great your stocks are. The whole market goes down, and it drags almost everything down with it. And then there's the third one. And this one is the sneakiest of them all. Purchasing power risk. It's like a silent thief that slowly eats away at your money. Our sources use this incredible example. Imagine you put $1 in the bank back when gas cost $1 a gallon. Well, today, you still have that $1. But if gas is now $4 a gallon, the power of your dollar has been destroyed. That's the real threat of inflation. Okay, so you've got all these risks floating around. What's the number one thing everybody tells you to do? Diversify. Don't put all your eggs in one basket. And, it sounds smart, it feels safe, but what if I told you that this very common advice is a totally incomplete solution? That your so-called safety net has some seriously big holes in it? Our sources use this amazing analogy, and I just want you to let this sink in for a second. That core strategy that almost everyone relies on for their financial security, diversification, it's just a flu shot.
Look, a flu shot is fantastic if you're trying to avoid the flu, but it's not going to do a single thing for you against heart disease or cancer, right? It's the same exact thing with diversification. As you can see here, it works great against non-systemic risk, that's the check mark. If one of your companies has a problem, your other stocks can buffer the loss. But when a systemic crisis hits, or when inflation just starts roaring, diversification offers almost zero protection. Why? Because in those scenarios, everything tends to fall at the same time.
All right, so if diversification is this leaky bucket, how do we actually build a real fortress for our money? Well, this is where a completely different type of asset comes into the picture: commodities. We're talking about real physical stuff like gold, silver, oil. These things can provide a kind of protection that stocks and bonds just can't. This quote just gets right to the core of it. Think about it. Any company, no matter how big, can go bankrupt. It can be mismanaged, it can have a bad quarter, it can just fail. We've all seen it. But gold can't go bankrupt. Silver can't miss an earnings call. There's no CEO. Its value isn't tied to a balance sheet. It's tied to huge global forces of supply and demand. It's not a company, it's just metal. So the magic behind how this works is a concept called inverse correlation. Sounds fancy, but it's actually super simple. It's like a seesaw. When one side goes down, the other side goes up. And that opposite movement, that is an incredibly powerful way to build a portfolio that can weather any storm. Let's actually see what this looks like.
Okay, so let's look at this chart. This tracks the US dollar. See what's happening? As people get more worried about the economy, or as governments create more money out of thin air, the value of the dollar can start to drop. This is that purchasing power risk we talked about, happening in real time. The cash you're holding is literally becoming less valuable.
And here is the other side of that seesaw. This is the payoff. During that exact same time the dollar was falling, look what happened to gold. It went up. It's not a coincidence. When investors get scared that their currency is losing value, where do they go? They run for safety. And for thousands of years, that safety has been in hard assets like gold. One goes down, the other goes up. That isn't just diversification, my friends. That is genuine insurance. So just owning something like gold is a great first step, for sure. It's a solid defense, but the pros, they take it to a whole other level. They move from playing defense to actively controlling the game. And they do that with a powerful strategy called hedging. Okay, to really get this, our sources use this perfect analogy with an airline. Let's walk through it. Step 1. The airline knows its biggest risk is the price of fuel. It's totally unpredictable, and they can't control it. So what do? Step 2. They buy an insurance policy, in this case, an options contract, that lets them lock in a price for fuel in the future. Now, step 3. A crisis hits, and the price of oil skyrockets. The airline should be in huge trouble, but they're not. Because of step 4, they use their insurance and buy their fuel at that lower locked-in price. See what they did? They turned a massive, uncontrollable risk into a predictable, manageable cost. They didn't just hope fuel prices would stay low, they took control. And you might be thinking, okay, great for a giant airline, but what about me? Well, here's the really cool part. You don't have to be a multi-billion-dollar corporation to do this anymore. The same exact principles and very similar tools are available to regular investors like you and me. Probably the simplest way for most of us to get in on this is with something called an exchange-traded fund, or ETF for short. Just think of it like a stock that you can buy and sell all day, but instead of tracking a company, it tracks the price of something else. So you don't have to go out and buy a bunch of gold bars and stick them in a vault. You can just buy shares of an ETF like GLD, and you get that exact same price exposure in your brokerage account. It's that easy. And remember that insurance policy the airline bought? That's what an options contract is. Now, a lot of people hear options and they think, wow, super risky gambling, but that's not what they were originally designed for at all. They were actually invented for risk management. The pros use them defensively, buying something called a protective put. It's like buying insurance on your stocks. If the market crashes, your put option gives you the right to sell your stock at a higher locked-in price. It literally puts a floor under your investment. This last quote just ties it all together perfectly. It's the whole mindset shift in a single sentence. It's about looking at the world, figuring out what you can't control, like the direction of the whole market, and then taking active steps to hedge it, to insure against it. It's the difference between being a passenger getting tossed around and being the pilot at the controls. So, I'll just leave you with this one final thought. Take a hard look at your own portfolio. Ask yourself this question. Is it just diversified? Is it just a flu shot, hoping it never has to face a real storm? Or is it truly insured with assets that can actually protect you when things go wrong? Because answering that question, that is the first real step to finally trading hope for control.